Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
On today's episode, we have two giants. We have Dario, David, and Farhan and Lalji. They're co-founders and general partners at LTV Capital, focusing on investments in top-tier emerging managers globally. They had experience working together at Anthem Group, co-leading fund and fintech investments. Today, they're going to share with us their unique approach to evaluating emerging managers, what they see as the biggest opportunities investing in VC in 2025, and why their LPs are choosing to work with LTV. So with that, I want to welcome Farhan and Dario. Thanks for being on.
Thanks for having us.
Thanks for having us, Ernest.
Dario, you start how you got here.
So, it's pretty simple. I think for myself, I have originally got a corporate finance background, but always been interested in technology and venture capital. Started off essentially in institutional corporate finance at Goldman Sachs, realized it wasn't for me, moved into an operator role to get first-hand exposure. I think it's so important that you want to be a good venture capital investor. Moved into early stage investing together with Farhan and Anthem. And then from that, because I'm such a product-focused person, ended up seeing funds and an opportunity to invest in emerging managers together with Farhan as our kind of ways of thinking aligned. And now we've co-founded LTV to invest into emerging fund managers.
Awesome. And Farhan, can you talk about your journey as an entrepreneur and operator?
I'll try to keep it brief. As a Canadian with a background in software development and product management, then the MBA here at London Business School, where I now teach, and then did the journey of going to a big tech company, realized that wasn't for me, then did the startup thing several times over, built a few businesses along the way. One of those was fortunate enough to raise capital from Anthem Group. Mm-hmm. And after that exit, I joined Anthem, where I had the great luck to start literally a month after Dario. And our lives have never been the same since.
Can you guys talk about that? You guys started a month apart, and then how does it come up that Anthem is a great investor in their own right, that you guys say, hey, we want to build something new on this platform? How did you guys come to that?
So I joined Anthem to build companies and part of our venture building kind of activity at the earliest stage. And Dario and I got to work quite closely on building companies. And one of the things we realized is that there's so many gates to actually get the investment done within that structure. And it was fine. We had the LP side of things. We were doing basically a vehicle with BBVA, the Spanish bank within Anthem Group. So we were co-investing with BBVA, or we were investing on behalf of BBVA. And so we were working with them on the companies and on the concepts and how we were building companies and all of that. And it was a lot of hard work. I think after we had deployed that capital, Dario was looking at a fund that was in a different thesis area. And I was actually thinking about going back to the operator side and maybe building something new, but had this portfolio of companies to manage. And then a lot of times it's just good fortune, right? So we had a few distributions from funds that Anthem had invested in. And that kind of made us kind of think, well, hold on, we're getting capital returns from funds that we had invested in for strategic reasons, right? We're investing in these funds thinking that we'll find good co-investments and follow-ons, but in fact, we're actually making returns here. And that kind of got us starting to think about, hey, could this be a product? The other thing that was happening was this mass proliferation of new fund managers in the ecosystem, right? Yep. So we were seeing over the last 5 years just a ton of new fund managers. The companies we were investing in were going out and they were raising capital, or they were meeting fund managers that weren't household names. But when you looked under the hood, you found that actually the managers were really, really interesting, with interesting backgrounds that were really relevant to the companies we were helping to build.
For me, originally coming into the firm, investing into early stage fintech was one thing. As Farhan mentioned, I've also got a nice passion for the media industry, and that's also how we bonded separately. And having that exposure and opportunity to co-develop a thesis and understand funds as a product as opposed to just deploying capital, which is traditionally where a lot of investors just want to, they don't really care where the money comes from and say, let's just invest. I want to know how do we raise the money? How do we think differently? How do we structure the fund? how do we source optimize deal flow? And that experience combined with the investment angle and the opportunity that was breaking down the barriers to allow for new emerging managers to enter the space, and the way Farhan and I were thinking about it, together with more and more research that was coming out from software platforms and market researchers and venture that demonstrated that emerging managers outperformed established managers, was this kind of idea of, hey, let's explore further.
Yeah. Were there any, before we get into the exact strategy and kind of spinning out with LTV Capital, were there any experiences at Anthemis or outside of it before you guys got there that have really shaped how you view venture capital?
I'll go first. Yeah, I mean, I think just being around some exceptional managers and seeing how venture is a really hard business to scale. The founders of Anthemis were sitting on so many boards, right? And it's really, really difficult when you're on that many boards to really add value to every company that you're working with. And at least for me, right, I was kind of looking at that and thinking, is that the future that I'm looking for, right? Do I want to kind of be sitting on 40 to 50 boards, and not necessarily being able to give them everything they need from a board man? And I don't think, VC or venture capital investors need to really add value to every company they invest in, right? There's like a time and a stage that companies need more support from their investors than others, right? And there's different investors who have different capacity and different capabilities who can add value at different points in time. But I was seeing that and kind of thinking through, like, actually, do I want to sit on that many boards? Do I want to kind of have that feeling at the back of my head around, hey, am I really adding value on this board or not?
Yeah.
For myself, there are kind of three standouts. One, as an operator, I joined a firm called Jumo FinTech, early stage in South Africa, employee number 60 within a year and a half, 350 employees across 7 countries globally. Direct exposure, they were blitzscaling on purpose. I learned a lot about how politics affects operational structure and strategic decisions, cap table management, product development, and how a company that's essentially, we were sharing 10 individuals per one desk at a time. It was really invaluable. The second was at Anthemis, which was when we were investing into early stage fintech, which was really around being part of a single LP vehicle. And working with a corporate creates its own challenges because corporates have this fine balance between wanting to be innovative and investing into early stage, but at the same time, there are other influences that can affect the ability to get that investment over the line, as opposed to a multi-LP discretionary vehicle. And so whilst frustrating, it also was a very great learning opportunity.
One thread that I want to pull as far on is the question of, should venture even scale, right? Does it change? Is it and this can go into kind of the motivation for even starting LTV Capital, but you clearly have a view on emerging managers. But I'll let you try to take a bite of that huge question.
Yeah, I'll try to be succinct.
Yeah.
Right? And I joke when I'm teaching at LBS that the answer to all of life's questions are one of two answers. One is follow the money. And 2 is it depends.
Hey, I knew you was gonna say that's what I heard from every business school professor. It depends. Absolutely.
It depends and follow the money, right? So, and I think both of those statements can be true for that point around, does venture scale or does it need to scale? So in a lot of cases, it does scale when you think about the AUM and the fact that a small fund wants to manage way more capital to generate more fees. And that isn't necessarily beneficial to its LPs, because you might find that actually from a DPI and all of the other factors that LPs are looking at in terms of the return profile, you don't always get those huge returns as funds start to scale and become larger in terms of their AUM. So that's one thing. The other point is sometimes a manager really needs that first small fund to show that they can actually run a portfolio and deliver returns. And then, they can manage what the optimal fund size should be. But it probably levels out at some point. So here in Europe, we have a great early stage fund manager called Seedcamp. And Seedcamp, I think, has done a really good job because Carlos and Reshma have been quite diligent in saying, yes, we might be able to go out there and raise double our fund size, but that's not necessarily going to ensure that we generate the best returns for our LPs. So some fund managers have doubled or tripled their AUM from fund to fund, or their fund size from fund vintage to fund vintage. But others are like, actually, for our model, it makes sense to kind of capitalize at a certain level and to kind of say that's the optimal level.
I love that. And Dario, there's one thing to have this, hey, there's a there. But what's kind of like the final push of like, oh yeah, we should do this. We should create LTV Capital.
Well, I mean, I think there's a couple things. I mean, man, I can still talk for hours. I think for starters, there is a combination of skills and experience that Farhan and I have, which we feel is, I wouldn't say lacking, but quite rare in the LP community that invests into venture, particularly in Europe, as the mindset towards venture capital is very different to the United States. It's less mature, right? And so as being ex-operators, ex-direct investors, having a fund investment track record, even having that corporate finance or institutional exposure, even teaching for both of us, it gives an element of being in the trenches. And quite frankly, we're derivatives of derivatives. We're emerging managers investing into emerging managers. So I think that being in the trenches and being relatable and building rapport with those managers is particularly important, because we understand what it means to provide value to founders, and we understand what it means to provide value to LPs, and we understand what it means to enable GPs to focus on actually getting on with the success side of their portfolios, while making it easier to connect GPs and LPs together. And most importantly, being positioned in London and having the global pipeline and access that we do. We've been very intentional there because of the nascency of the industry in the UK. We're able to prove that, hey, we can actually be the connective tissue between the United States, other regions, and the UK, and help to build industries as opposed to neglecting.
Yeah. And I think whether it's LPs or GPs, in a world of more consolidation, as well as fragmentation and globalization and deglobalization, being connective tissue, that's going to be the organizations that help their investments win, especially with all the automation. I think I've said enough TION words, but really, we have a lot going on in the market today. And if you're able to connect with individuals and then connect them to where 1 + 1 = 5, you're going to see returns. Why so bullish on emerging managers, though?
So I think like everybody throws that stat around of how many of the best performing funds in the last few vintages, what percentage of those are emerging managers. But I think for us, it also came down to how many LPs just didn't know how to assess emerging managers. And even like the new fund managers that are trying to do emerging managers, they're still trying to look at track record. For a lot of emerging managers, track record doesn't exist. And to Dario's other point about like why we decided to start LTV, we just thought like our backgrounds as having been entrepreneurs, having been operators, having been GPs ourselves, it's quite a unique background for both of us to come together to say, okay, we feel like we can really evaluate what good looks like on that front. So we saw that kind of opportunity because talking to a number of GPs, whether that's 900 or 1,000 or more now that we've probably got in our CRM, right, that we've spoken to, they see that actually most of the LPs that they're pitching to, they might be family offices with generational wealth where, you know, the entrepreneurism in that family's there, but the people who really had to hustle to create the business were generations ago. Or the institutional investors who are looking at fund vintages 4, 5, and 6 or beyond, where they can see kind of the data points and all of that.
What are key indicators you look for potential success?
Yeah. So for me, it's pretty simple, right? So it comes down to 3 things. 1 is understanding your why. Why are you doing this? 2 is how you think. Are you proactive or reactive in terms of your thesis? What I mean by that is, based on your skill set, your background, and your exposure, how do you see industries and themes within industries evolving over the fund life, i.e. 7 to 10 years? And is it, I mean, it should be uncomfortable for some LPs because not every LP is going to agree. And the third really is down to your network on the back of that, because that's inevitably where you're getting optimized deal flow, which is your key differentiator actually, because it's being driven by your purpose, i.e. your mission and value, as well as how you think and the way you've developed your thesis. And there are too many funds that have come into this industry for the sake of jumping onto trends because it's quick to raise money and you can earn a 2% management fee, and life's a dream because you can invest in 30, 40, 50 companies, and if 80% of them fail and some win, then fantastic. It's almost easier than starting a tech company now that there's the AI boom. But it's not so simple anymore because we've seen a change in terms of macro environment. But yes, it's being crystal clear in terms of what differentiates you. And I'm so focused on that thesis development side of things because it's just so fundamentally important. And that's why you see emerging managers from atypical backgrounds as opposed to some who look for the ex-banker type or whatever. That doesn't necessarily mean you're going to win in this market at all.
Just to maybe kind of extend that a little bit, I mean, Dario's great at kind of asking that why do you exist type question and really kind of poking at managers around their differentiation. And then because of our backgrounds, diligencing networks is something that we try very hard to do in terms of introducing GPs to other GPs and kind of getting a sense of who they work really well with. Because the game is really a collaborative game. If you think about deal construction, if you think about follow-on investment, if you think about the co-investment, if you think about deal sourcing, getting deals done, whether it's founders or whether it's other GPs, who do they already have in their network? What's the source of the intro and how strong a network connection is the source of that as well, through to how many of our managers really enjoy working with that person, and then how many people in our network as founders or operators really enjoy working with that person. So I think the benefit of having been in the industry for some time, having worked at another venture fund, having been in the startup ecosystem for so long, means that our networks are pretty strong. And so we can validate that and we can kind of see, actually, do these people have the connectivity that they're promoting to have?
I love those criteria. And a lot of people who have been in this industry who are either spinning out or coming from atypical experience have been successful. And so it makes me think when general managers of sports teams are identifying talent, they talk about, oh, he has all the attributes, but then it's the intangibles. And I'll do a quick kind of personal anecdote. As I talk to LPs now, and I have a very far out kind of perspective of even when I'll start fundraising, there are two things that raise people's eyebrow: the amount that I'm looking to raise the first fund and the time period in which I'm looking to start that. And so I'm hearing like, that's very intentional. And it's like, is that a differentiator? It shouldn't be. But I asked, what do you see as like intangibles that you've have really drawn you to fund managers? And then what are some intangibles that you haven't seen in the market that you wish you'd see more of?
I love storytelling. And it's really hard to kind of like nail down what the intangible is, but when you see it, you know it, on that story that somebody can say around that atypical background. We've had managers who were managers themselves of famous artists and kind of got into the angel investing game originally, then setting up funds and actually starting funds with people they invested in who had billion-dollar outcomes. And so those kind of atypical stories where people don't necessarily come from like the Harvards or the Stanfords or the Oxfords or the Cambridges, but they hustled their way to be in the room. And then they took advantage when they were in the room. Those are the kind of stories that really resonate with me and make me feel like, okay, this is a manager who will not only get stuff done for their own firm, but they'll get stuff done for the underlying assets and the entrepreneurs that they back. So I'm looking for that resilience factor that we really kind of look for in entrepreneurs when you're a GP. I'm looking for that in the emerging manager. It's like, show me your grit, right? Show me how you've persevered or what you've done to kind of like stay standing on that front.
I think you summed it up spot on. I think, yeah, to sum it up in one word is maybe the hustle, two words, the hustle factor. I think there is this mindset in some geographies that in order to be a successful venture investor, you must have a banking background or be a chartered accountant or come from private equity. Sure, those are skills, but those are skills that can be taught at the early stage. Smart people pick these things up quickly. What they can't do is build a network and differentiate themselves easily. And that's why, like Farhan said, and that's why, again, going back to my points around ways of thinking, because somebody who manages a musician or somebody who perhaps was an ex-sports person or worked at a tech company or even was a quantity surveyor in the construction industry, they have a perspective and understanding of industries which others most likely won't, or access to individuals that they don't. And therefore, again, it boils down to creating opportunities for companies that are backable or entrepreneurs that are backable, which are atypical. And that's essentially where there's huge upside. Obviously, a huge risk too, but yeah.
I think that other point you made, Ernest, about like intentionality around fund size. So we can talk about intangibles on the individual involved, but there's also the intangibles of the firm and the funds. So like how they're thinking about deal flow, how they're thinking about validation, how they're thinking about their fund portfolio construction and those models and stuff like that. And just thinking about their intentionality, I do think that's also like one of those intangibles as well. The fundamentals of the firm and how they're thinking about that. Like we see a number of fund managers who are probably targeting too much capital or fund managers who aren't targeting enough capital for a strategy that they're trying to deploy. So knowing that they've been thoughtful on that front, you'd be surprised how many fund managers haven't actually been thoughtful in terms of fund size. What they've done is they've reverse engineered to say, oh, I want to earn this much salary. And so in order to earn this much salary, my fund size should be that. And that's been the first question, rather than how many companies can we actually help to build? What are the outcomes that we're engineering for? And then structuring the firm around that.
Or what have you had experience in? What is your background suitable for? Is it pre-seed, seed, Series A, growth? I'm also not surprised on how unintentional VCs have been over the last period. We got a little crazy, and unfortunately, I think because of AI, we haven't corrected all those things. But that leaves opportunity. Now we're going to take a quick break to speak with our sponsor.
Today we have industry experts Idan Netzer and Jason Kropp, partners at Sidley's fast-growing emerging companies and venture capital practice. Is there specific regulation that you all are tracking closely for your VC clients that our audience should also be tracking?
Ooh, so there's one again that gets me excited. It relates somehow to tax, surprisingly, but the tax treatment of carried interest as capital gain versus ordinary income has been in discussions for many, many years now. And there's always a lot of pressure on whether or not carried interest will continue to be taxed as capital gain. That is a major, major issue and a huge incentive for funds to be structured the way they are. The rules have changed a number of years ago, and there are new requirements that are slightly getting older, but they're a few years in the play now, which means that folks need to hold their interest for a number of years before they can benefit from long-term capital gain treatment. I would say keep tracking those developments, because there are lobbies out there trying to get that eliminated. We like that, obviously. We think it's a good incentive for funds and funds activities. So that's one. And the second one is, as we mentioned, qualified small business stock, which is a huge benefit from a federal tax standpoint, as well as some states which conform with federal, and you can get essentially tax-free distributions on earnings from small businesses. And most of the startups that we deal with, at least at the beginning of their lives, qualify, right? So one is understanding QSBS is absolutely crucial. And if you don't know what that means or exactly how that plays, you should go and read some of the materials. There's plenty of stuff out there. Read through it. So QSBS is one of them. Not all companies qualify as QSBS, and that's another thing to understand. So depending on the type of investments, I would urge GPs to try to steer their investments towards businesses that do qualify, just because that tax advantage is meaningful. But if they don't, that's okay, as long as you know it, as long as you understand that you're getting into an investment that will not qualify in the future.
Yeah, I've definitely been put in that position where the founder's legal team won't tell you if it qualifies or not. And you're like, well, that you did just tell me. Thank you. If you're not writing something down in an email to confirm this, then I know the answer.
So the market practice on this is for companies to make the determination and provide the assurance to their investors and, in fact, to their stockholders. Generally speaking, that includes employees as well, by a way of issuing what we call a determination letter that says, hey, you should know that, assuming nothing else happens and you hold the shares for 5 years, those shares qualify for QSBS, because that's the only tax record that folks would have when they take the position on their individual tax returns. That is absolutely the market standard by now. It's not an expensive thing for the company to do. It's a good service to its stockholders, and there's absolutely no reason not to do it, especially if you're qualified.
On my end, I do a fair bit of life sciences, biotech, and med device work, and so the changes at FDA over the last few months have been particularly notable for a number of the clients that I work with and the investors in those clients. First of all, there's a tremendous amount of expertise here at Sidley with respect to that world. And it's one of the reasons that I came here recently. But setting aside that expertise, it's just notable that there's a lot of uncertainty around drug pricing, around the ability to get through FDA processes and the like. What I've been hearing from colleagues here is that fundamentally the FDA is still open for business. The FDA is doing its job. Responses are coming back. But having an understanding of how the FDA thinks about things and how the FDA will deal with certain questions and how companies ought to be dealing with inquiries from the FDA is more important than ever.
Thank you for joining us on the show. If you are an LP, GP, or founder interested in seeking Sidley's expert advice, you can find each partner's contact on Sidley's website.
And now back to our LP interview.
You both have spoken about a word I love, resilience. And it's something that you need emerging managers to have. And not just emerging, you need fund managers to have. And I've gotten a sense from talking to you in the pre-conversation and this one that you all are hands-on LPs. What are some of the obstacles that you try to help emerging managers on, whether it's like before you commit, after you commit, and then just like, as you re-up as well?
So, I think even just before we commit, it's really around storytelling and narrative, portfolio construction and size. It's that balance of how much value can you actually provide to your portfolio companies. And for example, if you're a solo GP and you want to invest into 50 companies, how much value, can you really be attentive to all 50? Whether it be around fundraising strategies, optimization for thesis. And even when it comes to working with those fund managers, it's about being able to be easily reachable as almost a shoulder to cry on. It's about building a relationship, because I think the thing is, you got to understand is how many GPs are out there to build a fund versus building a firm. And that goes beyond just fund one or fund two or fund three, because we define emerging managers as sub 100 mil fund one, twos, and threes. So we're in this for the medium to long run, in the sense of depending on how you define what that is. But what I mean is building an established firm that's impactful to an ecosystem within their respective regions. And that's particularly important.
Yeah, I'll add a little bit. I think, initially, I think one of our differentiating factors in how we work with our GPs is also we're quite transparent, right? Mm-hmm. I think if we're not going to deploy capital, we try to be upfront about why they wouldn't be a good fit for us, and we try to help them still if we can. The number of GPs who we stay in touch with where we've said, actually, you're not going to be a fit for what we're trying to do, but yet we've still managed to add some value, right? Mm-hmm. Whether that might be helping them with an SPV of a follow-on round, or whether that might be introducing them to other managers or other LPs in our ecosystem that we think would be a better fit for them, right? So trying at that initial stage to be transparent, telling people where we are in the journey and why our thesis might not match up quite well with the fund that's presenting to us, and trying to give them that feedback around it. And then where we can, adding value on that front. And I think when that comes initially, as Dario mentioned, all the things around the firm, but then subsequently, it's the underlying assets, especially if they're doing stuff in fintech where we can really kind of add value because of our background and our networks, or if they're doing things in other areas where we've been fortunate enough in terms of working with people who are at OpenAI or people who are at large organizations. So there's a lot of connectivity for the underlying assets as well that we can try to support the portfolios of the managers we have in our ecosystem as well.
Yeah. I have a quick question for you, Farhan. And I heard another LP use this term, and I never thought about it, so I'm going to ask you guys as the first time. But would you see yourselves as first close LPs, last close LPs, or it depends?
What's the answer to all of life's questions, right? So,
I knew this is why I asked you.
So a lot of times, transparently, we've seen managers when we didn't have capital to allocate, right? So depending on where they are in their cycle and where we are in our cycle.
Yeah.
So there's been times where we've wanted to get into a fund at the first close. There's been times where we were the first to commit to a fund manager. But there's also a number of times where we've been the last and they've left room for us to kind of make sure that we did get some allocation as well. And we're happy either way, right? So there's not like a hard and fast rule that we have to do first close or we have to only do final close. Some fund sizes and the momentum that fund managers have, others move slowly and actually want to be quite thoughtful and want to start very slow and very small. And so it really, really depends on the fund size, where they are in the fund cycle, and when we've come into contact. I mean, we meet people and it's obvious that they've got a month before they're going to hit final close. And sometimes you're like, yeah, we're just not going to be able to do that. As much as we move faster than we might have in a larger institution, we're still unable in some cases because we've been diligencing other managers that we've known for 6 months. And so we have to prioritize where those relationships lie. And we want to be quite thoughtful in terms of how we diligence managers and how we evaluate networks and how we progress with these managers. So sometimes we're going to miss out on that front. And I think that's okay as well.
Dario, who are your LPs? How would you characterize them? What's the demographics?
Yeah, sure. So I think, obviously can't disclose specific names, but I think
Absolutely.
What's important to understand is there's diversity on LP base. So from institutions, right, through to high net worth individuals, portfolio company founders. Geographically, it's a combination of both non-core markets. What I mean by non-core, I mean, I'm South African, i.e. non-US, non-UK, aka emerging markets, as well as a select few from more established markets. I think if you look at our venturing forward report that we put out in July last year, where we took a sample of our, at the time, 800 plus GPs, you'd get a good understanding about how LP sentiment affects the appetite to invest in GPs between emerging markets, UK, Europe, and the US. And that applies to us as well, because we too are raising and we too are emerging managers. So it's a great way to build rapport, right? But I hope that gives you some scope.
Yeah. And why do you think they come to you? Is it for, I would assume, exposure to emerging managers globally? Is that to get in their venture book, right?
I would say there's a number of different reasons for a number of different types of investors. For some, it's because they can't allocate to all the managers. So we provide them like an index. We see that actually some of our connections or some of our prospective LPs or some of our existing LP and investors, we're going to be the only fund they allocate to. And there's others who want kind of the access and will be making LP commitments themselves. And there's even others who are like, I won't do any funds, but I'd love to see the deal flow from the underlying portfolios and try to do co-invest on that front as well. And then to Dario's point, there's some from a geographic spread or some from a sector specific, whether they want to dig into a particular sector. I mean, we talked a little bit about AI, but there's so many fund managers who are really kind of labeling themselves as an AI fund manager. And a lot of our investors don't have the capacity or the capability to actually evaluate emerging managers just because there's so many of them. It's a full-time job for the two of us to meet and evaluate and understand managers. And for a lot of LPs, they've got their hands full going through the data rooms of the re-ups and the co-invest and the other assets that they manage. In some cases, with families and multifamilies, they've got a number of other assets that they're already looking after. And so they don't have the capacity to evaluate hundreds, if not thousands, of emerging managers.
I've been thinking about this the last couple of years as the market has shown some shifts. We've had more and more seed and pre-seed fund managers come about. It's looking like we're going to have more spin outs and kind of the early growth trying to become those firms. And then we have our largest firms competing with YC all the way to Merrill Lynch. And so during that entire period of time, we've also seen a lot of people like allocators complain about fund to funds. But with that and where everything is, it seems like there are places to get venture beta. But the question is like, is that, if you compare that to alpha and large private equity firms, I don't know, which should you choose?
So there's two trains of thought here. There's the fund economics and the fundamental side of it, and then there's the kind of ego side of it. So let's address the ego side of it first. Depending on the LP type, because there's so much activity happening in the venture space, and now with the AI boom, that's the next big thing to jump on. It used to be climate, it used to be Web3. Family offices, etc., think that they can do this themselves. And so they feel like there's enough to go around. So we really have to prove ourselves like, hey, we have differentiated deal flow and here's why. So there's that. There's also on the other side of it, on the contrary, a lot of post-2021 scarring, the dumped valuations. So some are moving away from the likes of tech and venture and sticking to their core, which is what's made them money, whether it be real estate, public equities. I mean, look, the markets this week haven't been great, but whatever. But in terms of fund economics, you've got to understand that a fund of funds essentially is charging fees on fees. So while 1% is low, at the end of the day, you're paying 1% on top of the fees that are charged by the underlying fund managers you're investing in. So you've got to be crystal clear in articulating your value in terms of the direct opportunities you are providing, i.e. co-invest, whether there are fees on those co-invests, what strategic value you're providing, what differentiated access you're providing in terms of that pipeline. And therefore, it's not going to suit every LP type, but nonetheless, it's an emerging asset.
I think there is a lot of hubris in a lot of different institutions around being able to do this themselves. I mean, the number of families or the number of prospective LPs that we talk to who've lost money. And the other fact is the distributions haven't been there. The returns haven't been there for a lot of vintages and it's funny that no matter how much we talk about actually when there's downturns, that's the time to actually deploy, there's still a lack of that, I guess, kind of that belief that actually this is the time to actually deploy because you're so worried about the things you've already committed to and seeing that. And so we find that a challenge in terms of LPs who, I think it's funny because like where we've seen, I think, the most success is people who've actually allocated to a large number of venture funds. And so they realize how difficult it is, right? And then there's the other side where they haven't done it at all because they realize how difficult it is, right? It's the ones in the middle, the big bell curve, right? For those, that big bump in the middle where they've either started to invest in VC funds or they've got a portfolio or they think they can do it themselves, where that's the challenge, to get them to a point where they come to that realization that managers in venture and emerging managers particularly, it's hard to kind of like see everybody and see the ones that are actually going to be the top performers.
Dario, what are you all excited about for this year?
I mean, for me, it's legacy industries. Farhan certainly beat this drum. I think everyone is AI is the sexy thing now. It was climate, it was Web3, it was freaking fintech a few years ago, payments. Now it's legacy industry. It's the unsexy stuff. That's what matters because it's less ego driven. There's a lot of specialized knowledge. There's a lot of opportunity for change, whether it be inventory supply chain management on cruise ships, or optimizing for dry cleaning.
I started my career out at a corporate VC and focused on a lot of tech-enabled services, vertical software, applied AI, and it was not in vogue. And most of the time, people would tell me, "I don't know about that TAM." And now all you hear is like AIs for services, and services are all the rage. When I never like a SaaS company, the golden SaaS company, which is Salesforce, as it got bigger, it became a services company because that's what happens. Where do you guys see venture exits going?
I wish I had the crystal ball. Right? I think we're going to continue to see this bifurcation, and so companies staying private longer. I don't know if the IPO market comes back. And it's funny, I was talking to a friend who is an LP in a lot of funds and works for a large Canadian bank, actually, just earlier today. And we were talking about this particular kind of point and how Amazon's market cap when they IPO'd was 300 million. And it's kind of like, if
Wow.
you like the public market side of things for like, and so when we talk about liquidity, when we talk about returns, the world's changed dramatically, and we haven't seen the same kind of innovation and the same kind of like thinking around how the world's evolved on that IPO market. And so I think there will be something. I just don't know what it is. Like I've seen strategies for roll-ups, I've seen strategies for secondaries. We're seeing all of these kind of innovations or new fund portfolios constructions coming to market. I don't know if any of them have it absolutely right. And I think for the large allocators, it makes sense that they should be looking for the billions of dollars worth of value in terms of the exit, the asset value of the companies that their portfolio managers have invested in. But if a company exits for $500 million, you should still be able to return a good amount of capital to your LPs. There should be a lot of entrepreneurs and executives who get rich in an exit of $500 million as well. And so how do we kind of encourage the innovation to exist? Because I mean, if you think about AI and all of these other technologies that are existing, it's kind of like the wave that the cloud had in cloud infrastructure, where to actually set up a company became so much cheaper. And so now we're seeing that actually companies like Lovable and others are enabling you to build applications really, really swiftly and for not much, and getting up there in millions of dollars of ARR really, really quickly. And so if you can have a one person driven $100 million exit, somebody should be financing that and making really good return off the back of that. I just don't know if enough people are thinking about that on the smaller liquidity side as well.
Yeah, M&A is still the dominant exit route. You got PE-driven acquisitions, corporate buyouts. I think at the end of the day, funds need to generate DPI. And if you can do that, then sure, you're in a position, do you want to recycle that capital or do you want to return it to LPs? Fund valuation, I mean, we're starting to see valuations recover, which is great. But nonetheless, we have been in a pretty tricky minefield the past 2 years. It's great to see that things are recovering and rebounding at least. But again, the jury's out. There's a bit of a hype factor. Are we going to see a repeat of kind of that post 2021 hangover, 2022 hangover? I don't know. Activity on the ground suggests otherwise, but as Farhan said, no one has a crystal ball. Can't call me Yoda, but hey, we can be optimistic at least.
On that note, any parting thoughts to our audience of GPs and LPs? I'll let you go first, Farhan.
Keep doing the good work. Like we need people with entrepreneurial spirit, building funds. We want to keep seeing interesting managers and this idea of atypical kind of backgrounds. I think the world needs more atypical managers. And so I hope we will continue to see more atypical managers. So people with atypical backgrounds, I hope they consider this as a career path and a way to make impact.
For me, it's don't be afraid to think differently. In securities or in trading, people say this: in the money, at the money, out the money. Don't be afraid to be out the money. Don't be afraid to hear LPs not understand your thesis. It's happened to me. It's happened to us. And you've heard the complete opposite. I think, yes, the market is frothy, it's a red ocean, but at the end of the day, every market is competitive. That doesn't mean you shouldn't try. So there are LPs that are open-minded like us. There are LPs that are trying to make a difference in the ecosystem. We're trying to educate the ecosystem, whether it be on this platform, whether it be in our respective individual capacities, teaching or through online courses. So yeah, I think don't ride the hype train and be introspective on your network, because you'll be very surprised when you think about it, what people you do know and what difference that makes in terms of your value proposition as an emerging fund manager.
I love that. Farhan, Dario, thanks so much for being on the podcast.
Thanks,
Really
Ernest.
appreciate your insights. Thanks.
Thanks,
Likewise.
Ernest.
All right.
Cheers.
See you later, allocator.
After Portfolio Tile, investing with a smile.